Here's why Citadel's customers are about to lose everything. This is a very intriguing article that I want to bring to your guys' attention because Citadel is in a very dire situation. Also, there's another hedge fund that has announced they are closing their doors, and at the end of this video, we're going to be going over this Evergrande situation, why this is being thrown under the rug, and financial media is not talking about this, as well as which funds and banks have the most exposure to Evergrande that we know of. So hit that like button for me, consider subscribing to the channel, and check out the pinned comment down below, as well as the links in the description to get all the free stock your heart desires. So let's jump straight into this article. This was December 8th, 2021, so just a couple of days ago. It says, obviously, here's why Citadel customers are about to lose everything. Citadel's customers are in for a massive shakeup entering 2022. The hedge fund just updated their liquidity terms for all investors, and the institution continues to lose money on bets they are not willing to close. They are limiting quarterly withdrawals to 6.25%, meaning it would take 16 quarters or 4 years to fully pull out unless the client is willing to pay a fee. And this is very interesting. If you did not know this, Citadel actually did this during the financial crisis of 2007 and 2008. For 10 months, Griffin barred his investors from withdrawing money, attracting criticism. At the peak of the crisis, the firm was losing hundreds of millions of dollars each week. It was leveraged 7-1, and the biggest funds at Capital finished 2008 down 55%. However, they rebounded with a 62% return in 2009. That 7-1 leverage ratio, very important. They are even more over leveraged now than they were during the financial crisis of 2007 and 2008. And to be quite honest with you guys, the markets in general, besides this article and everything else we're going to talk about, is really rocking on the few key stocks: Apple, Google, Amazon, Microsoft, Facebook. If these stocks go, you're looking at flat out bankruptcies across the whole hedge fund spectrum. It's not just going to be Citadel, but this is a huge red flag. Now let's continue on with this article. It goes on to say, unless Citadel Securities closes their heavily shorted positions in both AMC and GameStop, clients are in for more losses heading into 2022. And this is music to my ears. This is really what we already know, but to get more validation and confirmation is nevertheless a great thing. Should clients pull out? It's definitely worth considering. And then we're going to skip down here. It says Citadel's funds are currently closed to new investors. So if anyone quits, they might not be allowed back in the future. The hedge fund has given this desperate ultimatum to its customers in efforts to hedge against losing bets. Citadel Securities has lost billions of dollars all year betting against AMC and GameStop. Retail investors have been fighting this adversity from trying to bankrupt two of America's favorite companies. The hedge fund has also been notoriously shorting AMC stock despite all talks of bankruptcy officially off the table since early 2021. And that's the key thing. It made sense to short AMC a year ago. Now you're in a losing war. You're losing the battles. Ultimately, will lose the war. They are not holding back. They are going to lose all of their customers' money before they actually get out of their AMC and GameStop short positions. Now, Citadel is not stopping besides billions in losses, and it's costing their clients a lot of money. Now, Citadel Securities is making it tougher for clients to withdraw their investments. Citadel will eat every single one of its clients' dollars to fight retail investors. And that's what this is. This is really an egotistical battle at this point. It's not about fundamentals. It's not about shorting a bad company. It's about the ego battle between retail and institutional investors. Now, will Citadel keep losing money? The entire stock market has been volatile in general. However, Citadel Securities has amounted billions of dollars in losses due to over-leveraging short positions in AMC stock. Retail investors continue to buy and hold the stock until this hedge fund closes the millions of borrowed shares they have open. And until they do, customers will continue to face significant losses entering 2022. Clients can expect to see the same pattern from 2021 if Citadel Securities does not cut their losses. AMC is not the only stock incurring losses for the hedge funds. Citadel Securities' business model is built on shorting stock to earn money on the downside, and that's the problem. They're betting on losers instead of winners. Citadel Securities is one of the largest hedge funds in the world. They've created massive systemic risk for the entire U.S. economy. Hedge funds such as Millennium, Susquehanna, and 638 are also at risk. Clients have a better chance at yielding returns by opening a brokerage account and investing in an index fund every month. More of the general public is learning how to invest in stocks. And that is a very key thing as well. More of the public now, since 2020, is feeling more comfortable investing their own money. So I do think that is really what is happening overall on top of these bad bets on GameStop and AMC. If you're a client of a hedge fund and this hedge fund on paper has returned 18% this past year, but the S&P 500 is up 26% year over year, they're still well underperforming the broad markets. Why would you invest in them? And I think that's where the whole systemic problem of hedge funds is really coming from. Besides if you're a Renaissance technology, something that has been returning over 30% year over year, why would you have your money invested in another hedge fund that underperforms the market? So on top of the bad bets, that's also the situation that is going on behind the scenes. Now, this is really important as well. This is key. Analyst says buy GME and AMC before Evergrande crash. A veteran credit analysis is encouraging buying GameStop and AMC shares to hedge against a market crash. In this article, I discuss why the possibility of AMC and GME experiencing a MOAS is very likely due to an Evergrande crash. Now, Dr. Marco Menzler, an advisory board member of the German market screen agency, says crypto and meme stocks can yield a massive opportunity for investors. Retail investors in AMC and GameStop community have been right all year. Over-leveraged positions, dark pool trading, naked shorting, negative beta, all of it. AMC and GME stock are going to experience massive short squeezes, and hedge funds betting against these two stocks are about to cause severe losses for their clients. Very interesting article, and I think this article is spot on. Now let's talk about this Evergrande let's talk about the Evergrande situation, since we just heard the analysis and the analysts talk about how this could be a hedge for a downturn. And that is 100% true. All shorted stocks in reality are going to be prone for massive short squeezes once the crash does actually happen. And like we talked about in the beginning of this video, all of the money is piling into these key names, whereas your mid caps and even some of your large cap stocks and definitely your small cap stocks are all in bear markets, whereas Apple hit an all-time high on Friday. Google, Nvidia, Tesla, Amazon, all of these other stocks, Microsoft, are at almost all-time highs, if not all-time highs. Once these stocks go, the overall market is due for at least a 20% crash. Given the over leveraging that is going on, that is going to compound to even greater losses for the hedge funds. Now, let's get into this whole Evergrande situation, why financial media is actually throwing this under the rug. So you guys can take a look at all of these articles. Take a look at this. It says Evergrande default signals volatility, but no crash, analysts say. Evergrande slides into default while some rating agencies keep quiet. I think this is a big concern that nobody wants to talk about. You're not seeing this on CNBC. You're not seeing this anywhere. And obviously the Fed meeting, the debt ceiling, we have bigger near-term issues to worry about, the Fed meeting being this week, but this is also a very bad situation, not just for China, but for investors in America that are also invested in Evergrande and other Chinese property developers, or just the whole segment in general. Over 25% of Chinese economy, or the GDP of China, is in real estate. So that is a big problem. Nobody wants to talk about this, and China is letting them default. They have not paid the foreign bond notes of about $82.5 million and another $400 million bond payment that was not paid by Kaiser, another property developer that just went into official default. Now, who actually has exposure to Evergrande that we know of? And that's a very key thing, because not a lot of people are going to come out and say, hey, we're exposed to Evergrande. We're severely over leveraged on these bad bonds. We're about to take a lot of losses, right? Nobody wants to do that. And Evergrande does owe $305 billion and has run short of cash. $305 billion, that's half of what Lehman Brothers was in 2008. They had $612 billion of debt when they went bankrupt, and the United States did not bail them out. So this is a substantial amount of money that they have owed. Now, it says Evergrande failed to pay interest on a $2 billion bond maturing in March. It will default if it makes no payment within a 30-day grace period. They have also already defaulted on that $82 million payment, or just interest payment that they were supposed to make a month and a half ago. Now, it says Credit Suisse Group, not mentioned by Morningstar, sold its entire exposure to Evergrande debt last year, the Financial Times reported on Friday. Fellow Swiss bank UBS has Evergrande debt exposure totaling $283 million across multiple portfolios, Morningstar said. Ashmore runs to $146 million. Both declined to comment. BlackRock's exposure had recently increased in its Friday analysis. As well as that, they have about $8 million of exposure and another $1.5 million of additional exposure in September. We don't know the exact number of how much they do actually own. I believe it's a lot higher than $8 million. But BlackRock is a big fund. They're going to be able to take this hit a lot better than UBS or a couple of these other key players that do have a lot of Evergrande exposure. Now let's move on from this, because we obviously know this is going to be something that is up and coming. It usually takes a while to see these bankruptcies fully play out, and for that peak fear and the outstretching of the defaults that will eventually come from this. So it will still take a little bit of time. Now, this hedge fund closed their doors. Take a look at this. Macro hedge fund firm Anther Capital is returning clients' cash to become a family office following almost 2 years of poor returns. It says Anther has struggled since the start of the COVID-19 pandemic. The Anther Master Fund was among the biggest losers in the March 2020 sell-off in global markets, declining 20%. While it recovered some of the losses, it ended the year down 3.6%, according to an investor document seen by Bloomberg. The fund dropped 13% this year through May and is still in the red for the year. By contrast, it gained 8% in 2018 and almost 22% in 2019, the document shows. Very interesting. What are you invested in to be losing that kind of money? You're obviously shorting a lot of stocks because the market is up well over 100% since the bottom of 2020. So some very interesting, compelling information that was brought to you guys here in this video. If you guys found value out of it, hit that like button for me. Consider subscribing to the channel. As well as that, let me know down below in the comment section, what is your take on all of this information? Why do you think financial media is hiding Evergrande? How bad of a situation do you think Citadel is in? Let me know your guys' opinion on this, because after all, you are a part of this community. Check out the pinned comment as well as the links in the description for free stocks. Love and appreciate you guys. Thank you for watching this video. I will see you in the next one.